Hi, Chris. Hi, this is Oyen. So yes, sorry these are late, but let's go through. So I've done quite a bit of marking, and I'm going to send all this to you. So let's begin. So your work is quite interesting. I mean, I can see the progression, and I can see definitely that initially this is you sort of start off sort of trying to do this without looking at the answers, which is really good because it means when you go back now, you can really see um, where you can improve and where you have improved on. And so let's look at the first question. Let's look at 151. I've marked I'm marking all the work you're going to do, so we'll just start off at the beginning. So 151, if you remember, we'll go back to this business called Prancer Construction. And they give you they're like as usual, there'll be some knowledge questions, but there'll also be a lot of risks on actual assertions within the financial statements. So what am I saying? All these balances they'll talk about, typically they'll ask you to look at non-current assets, could be trade receivables, could be inventory, could be trade payables, and all those things are risks. All those things have to be attacked. Now remember that this question of audit risk is very much about the financial statement. So you're constantly trying to arrive, your last sentence at every risk is very much about X would be overstated in the financial statements, Y would be understated in the financial statements. The risk here is that we will give the wrong, or if you like, an inappropriate opinion because we haven't, if you like, looked for sufficient and appropriate evidence to find out whether or not that balance that's showing is right within material sort of boundaries. So let's kind of go to this business. So there's a lot of material here, just looking at what they're saying. So these guys, audit, new client, always a risk anyway. Then we look about audit strategy, but let's just look at the risk so I can look at the question as a whole. They have some work in progress. And these people, so as soon as you see they have a work in progress, property construction, so you don't need to know the FR so much, but the key point here is there's a potential for misclassification or poor classification between the capitalization of a lot of these expenses, the classification, the capitalization of these expenses. So those are the issues there. And then it tells us we have inventory here of this, and so that's the first thing. So we again. So it says we have this factor here. We have 2.1 million pounds worth of inventory. So the question here is we're thinking valuation of inventory. So we must talk about. So literally in every paragraph there are enough risks to latch on to. Here we have this business of inventory happening in 11 sites, and you don't have enough of a team. So that's a risk as well. So they're literally risks. And as you do these questions, you start to pick out which risks. You can sort of go for and get the most marks. Then there's this business here of offering a 5-year warranty, and it says here, like, I think you highlighted that. We'll look at your answer in a second. They anticipate the provision will be lower as he's improved. So that's a risk there. We need to sort of, he's trying to almost reduce his provision. You highlight that. And so the idea of trying to reduce a provision, as far as we're concerned from an audit risk point of view, is that he won't be putting in enough of a provision, therefore expenses being understated, if you like, and therefore liabilities being understated, if you like. So again, that's kind of where we're going, and therefore disclosures, a failure to disclose. So you can see where I'm going, that it's really about the representation in the financial statements that we're concerned about. Then, of course, it talks about this 5% non-refundable deposit. I'm sure you're reading this again as you're doing it, as we're reviewing this. But the key point here is that the risk here is when they pay this money, we're going to go debit bank, credit what? So the argument is are the accountants crediting revenue? And they can't quite do that because it's not revenue just yet. Because when the building is complete, then they can recognize it when the building is complete, not when, if you like, they receive the money, because it's not quite revenue. Nothing's been transferred. The principle of realization hasn't quite happened. So even though you don't know all the financial reporting, the principles, the core accounting principles apply. So it's really about classification. In fact, we need to be very careful about how we classify that 5%, a more deferred income, if you like. And then they tell us that the overdraft, there's an overdraft issue And you can see here, I think you highlight this here again, the fact that they have these minimum profit and net asset covenants. So there has to be a certain degree of professional skepticism, because we believe that they are likely to want to manipulate the figures to arrive at these covenants, if you like. And there is a potential going concern issue, therefore, because if they fail to meet these covenants, then we need to kind of be asking questions about whether they need to disclose that there is a going concern issue. So we see here that management period days is 56 days compared to 87 days. So really the general argument here is if we see a fall in trade payable days, which is unusual for any normal business because you're trying to delay that or keep it about the same, it means that you're probably losing your goodwill, and you're not able to have that power anymore. Basically, so you're losing your power of the power suppliers are growing, and so you're not able to restrict paying them, or you have to pay, or they're giving you shorter payable options, and you have to pay on time. So let's look at your answer. Sorry, I've scribbled over this. I've been marking this. I sort of mark it first and then talk about it. And so I want to go, this very first bit is a knowledge question. I believe this question says, describe the process of preconditions. So this question of preconditions really is part of, let me come here, is really part of the acceptance, the topic of acceptance. And I'm just coming here to, here, whenever this question of, it's a slightly focused one. Preconditions, it doesn't really just mean in general preconditions. There are actually certain specific preconditions. I mean, these are all issues to consider prior to, and I think in one of your later questions you talk about this, you focus on this, but these are all the things we need to consider, and there's quite a few you'll remember as you keep doing this. That's professional clearance, which you talk about in another question. But you can see that there's a number of things here. But again, all this you can only do as you keep doing questions. So don't feel bad about it. In terms of preconditions, you can see it's its own heading. So there's actually a couple of preconditions, and those preconditions are actually quite clear. So there's professional clearance and there's preconditions. And preconditions are very much about a couple of things. So this question of responsibility, first of all, the fact that the managers are very much aware of their responsibility. Of course, there is the question also of a framework, that we're very clear that there is a framework. Now, where is that? Here we are, preparation of financial statements in accordance with an applicable financial reporting framework, and then they're willing to provide you with all the information that you need. And then there's a certain level of internal control to give a true and fair view. To be fair, this one really means there must be some control. If there's no control, you're carrying out a purely test of detail audit, which is rare. So the key point is that it's more about responsibility for internal control. It's their responsibility. So that's really what's going on with this question of I'm just going to change my pen color here. This question of that's what's really happening with this question here. Sorry, that's what's really happening over here. Yes, that's what's really happening over here with this question of preconditions, right? So whenever you hear preconditions again, it's just very much focused on those areas. But I think I give you a mark because you sort of, to be fair, I probably shouldn't give you any marks actually, because you see what you've talked about here are all the things necessary, taking you back here to what you talk about, which is fine. Again, it's just revision. What you talk about is, sorry, let's recover the web page. Sorry. What you talk about when you saw that earlier on was this question of all the issues and things we need to consider before accepting an engagement, and preconditions, pre-clearance, fees, budgets, management integrity is all part of that picture. Okay, while that's loading, let's go back to the next question. So the next question asks the resources required and how these will be used. I'm sorry, the question itself says that identify 3 areas other than the audit risk which should be included in the audit strategy. Right. So now audit strategy as well is a slightly interesting area. So I pulled this up as well. And audit strategy, I always say think of a crime board. So the audit strategy, I think you mentioned a few things, which I think I gave you marks for those. Let's just go back to that. Yes, you said the resources required, yes, of course, the audit timetable, and not sure. So you're right. So that's kind of the key. I don't know what page this is, but we can see here that there's so much you could have picked. But again, you're on it. But audit strategy is literally saying, so we know what's going on with the framework. We've done all our understanding of this business. We know exactly what's happening with the business. We've calculated. We've done we know what materiality is going to be. We've done our we understand the internal controls of the client. We've looked at our risks. Um, we now, like what you talk about, we know what the timetable is in place. We've got our budget. We have the audit team. So the strategy is really a combination of everything. Really, the plan is us going in and actually carrying out a breakdown of exactly what it is we're going to do. So if we look at audit plan, it literally just really goes in. So the strategy is literally saying we have collected all the information we need. Now we can storm the place. But you can see it's broken up into characteristics of the engagement. This is all knowledge, by the way, so don't feel too so you can't remember everything. There's so much. But the key point is good understanding. Are we going to go in using CATs, the timing, client staff, characteristics of the engagement, the reporting objectives? So how long do we have? What's the timetable? I think you mentioned that. So yes, audit timetable. So I think I give you 2 marks over here for that. And then I think the next question really is this question of um, 7 audit risks. So I think again here your work is growing. So I think this question is you right there isn't a sufficient audit team resource to attend. Yes. So again, this question of accidentally and or deliberately overstated. And when I go take you to the answers, you'll see where we're going. Potential understatements of trade receivables. So a lot of this has to be expanded. You really want to expand your arguments. And you're right, but you want to kind of write a little bit more. And we want to bring it back to the income statement or the statement of financial position. What is being overstated? So typically go with either overstating or understating. You want to go right there. And you want to talk about what the risk is. Either the risk the trade receivables, again, like I said, has been understated or overstated. You talk here potential understatement of trade receivables. So you want to tell us exactly why. So don't feel you just want to drop the main point. Expand actually. When we go to the answer, you'll see what we're saying. Here I've put good because this business here of the profit and net asset covenant does increase manipulation, and this is probably one of the better answers. And this is another really good one. Let's look at the answers to really see, and I think by the time you see an answer, then you really know what we're kind of targeting here. So let's see. Let me see 1 second. Let me just go up here. So we've done that's preconditions, and then let's look at the risks. So again, like I say, we want to expand. There's no need to really go for it, and you'll get better at this. So here it says here that this is a new client, and you mentioned that. Just expand. You can see when I say expand, they're talking about it because you don't know why. There's an increased detection risk on the audit. So what should you do? A big answer. This is a popular question. New clients, all new clients, you're not familiar, experienced, suitable experienced team. Standard answer, if you like, and that you have enough time to understand all just like any project that you don't understand. And you start writing the answers. You just start repeating the right words, if you like. Gain an understanding and focus on those areas, those balances that are of particular areas of risk. And then, like I say, there is so much there, if you like, and this is about the actual financial reporting work. This question of here, work in progress, construction. The chances are that there might be issues here. They're telling us there's a material level of work in progress. That's what they do. So we really need to kind of spend some time trying to understand how they have arrived at this work in progress. And so you can see here the key consequence here is if the percentage completion is not correctly calculated, or if the inventory valuation may be understated or overstated. But like any work in progress, you can imagine there's raw materials, there's labor. So the argument here is, how have they arrived at this figure? That's really the issue, if you like. And they kind of, and as you read this, you start to understand the FR, the financial reporting behind property, cert to be fair. But again, whether or not you know it is not the issue so much. The point is, if you treat it like any whip, you understand. And then and I've noticed towards your other questions, your answers get better with always highlighting the fact that the auditor should discuss with management the process. And if you need to bring in an expert, excuse me, if you need to bring in an expert, bring in an expert. So you start getting this, you start understanding what the traditional answers are when you're dealing with inventory that you don't understand very well. Let's get your process of thinking from the managers. Say to the managers, what's your process of thinking? How are you doing this? Of course, you're attending the inventory counts, but if you need to bring in an expert, bring one in, right? Um, then we have this again, this question of inventory. Inventory must always be stated at the lower of cost and net realizable value. So you always want to write that down. This is a standard test of valuation of inventory. So you must, if you notice once in class, I was saying that a lot of audit response does sound like a lot of audit work. It does actually sound like a lot of audit procedures. There's nothing wrong with that. Actually, as long as you're not going on over, but we're basically saying you're going to have to find out, because this is valuation now. They've recorded 1.4 million for these reported properties. We want to be looking post year end to detailed cost and NRV to be performed. And you can see they're not telling us exactly what it is, but what test you're carrying out. But your response is, I will be comparing costs and NRV at the year end. And also looking at your, aged inventory report to see if anything needs to be written down. So we're really focusing on valuation. Again, this may indicate that these are overvalued. So hopefully your writing, you start to see exactly what's going on. You can't get to all 11 building sites. So there are a number of things you can do. You can look for the areas that are most significant, or the areas that are material, assess which of those you can attend, hire a local auditor to visit for you, and that's probably your best option. It says for those not visited, you have to kind of review. You can't answer everything. When I say you can't know everything, you can't write all of this. But the key point is you need to be thinking, I'm going to look for those areas that are material to visit, and maybe hire local auditors to go in and see for us. Because you see, by you not going, you're also missing the process of the controls behind their inventory. So you're going to have to explore that. A building warranty, this is what I was talking about. So this is a provision, as you would consider, if you can imagine, a provision like so this question of provisions, and you don't need to know IS 37, but the key point is that all provisions will have the question of judgment and the question of recognizing. He wants to bring it down. So again, this may be understated. And as you can imagine, they combine this with this question of the manipulation of profits. So you can see that everything is focusing on the financial statements, everything is focusing on the income statement. Discuss with management the basis of this provision calculation. Again, discuss and compare, again, for reasonableness. So you'll get better at seeing how these actually turn out. Again, I talked about the 5%. This should not be recognized as revenue. I sort of highlight that. And they might have recognized this deferred income as revenue, and it shouldn't be, if you like. So you should be looking to see that they have recognized it as deferred income. Again, this allowance for, again, you can see what they're doing here. Now he's telling us we're looking at trade receivables. So really the question really is testing trade receivables. Are trade receivables overstated? This is the risk, really. So we're looking post year end, extended post year end cash receipts. What are we doing? So I say really here, it's really a mixture of carrying out actual procedures to ensure that those figures aren't overstated. And then this is this bit where we talk about manipulation here, and review the covenants, and also any going concern tests. Really, you'd be looking at forecasts. You'd be looking to see if they're to see how far they've broken those compliances. And this is what I was saying earlier on. The argument here is that because there's pressure on them to manipulate those ratios, those current ratios, then they might be playing a few games. So what you want to do yourself is actually just we want to make sure that payables are complete, if you like. I mean, this is not this. I'm not assuming they might be paying their trade payables earlier. It might be. Um, so the argument is that if they're paying their payables earlier, it's interesting because it tells you the forecast profit is higher, indicating an increase in trade, and the cash position continues to fall. So it's unusual that if you're not getting your money in, why are you paying earlier? So you see what I mean? So it's interesting, something you want to investigate. So either there's some errors or there's some kind of understatement of trade year-end payables. So we want to look at all the payable circularization review of supplier statement reconciliations. So that's what's going on there. So I think that by the time you do this again, you'll be much better at attacking those actual events and highlighting them, and picking them out as risks. So risks to the financial statements for understatement, overstatement, if you like, is where we're going. So let's just go back to your work and just kind of see what was going on here. Yeah, so again, it's just an expansion, and you can see here we're almost carrying out procedures, but you have some good work over here, and I've given them grades. Cool, great stuff, and I will see you on the next question. This has been a long one, 21 minutes, sorry.